Okay, so speaking of the economy, the stock market dropped 1,000 points yesterday. It had gone all the way down 1,600 points yesterday. That followed a 666-point drop on Friday. Today, the stock market is basically bouncing around. It's, last I checked, it's up by 56 points or so. But you never know. On days like this, you really don't know until about 3 p.m. Like late in the afternoon, you're going to find out when the stock market basically get close to closing and people decide where they want to finish their portfolio for the day if there's a major sell-off at the end of the day. Now, everyone is going nuts about this. Oh my God, it was the single largest stock market drop in the history of the United States in terms of pure points. Well, who cares about pure points? That's stupid. That's like saying that the GDP every year in the United States goes up. In pure dollar amounts, that's true. In terms of percentage amounts, that's not necessarily the case in any significant order. And that's the case with regard to the stock market drop. Just because the stock market dropped 1,500 points at one point, it was about a 3%, 4% drop yesterday. That is not even close to the top 25 stock market drops of all time. So people who are saying that this is the end of the world are stupid. By the same token, now President Trump, I've been saying this for literally his entire presidency. The president of the United States, when he goes out and he uses the stock market increase as an indicator of economic health, I said this while Obama was president. I've been consistent in saying it while Trump was president. The stock market is not a good reflection of the underlying economic fundamentals. Plus, the stock market is not the responsibility of any one president. So the idea that President Trump came into office and therefore he is responsible solely for stock market increases and decreases is stupid. I said the same thing about President Obama, so I've been entirely consistent on this point. Another thing to know, when you see headlines saying that trillions of dollars wiped out in wealth, billions of dollars wiped out in wealth, not unless you're one of the people who actually sold, right? So if you have a 401k, your 401k is worth less than it was yesterday at the beginning of the day. Sure, that's true. If you tried to sell it, it would be worth less. But are you selling your 401k today? Do you have to cash out today? If you're not cashing out today, the answer is you lost zero money. This is why Warren Buffett was famous for saying things like during the 2008 crash, people would say, well, your entire portfolio, you lost billions and billions of dollars. And Buffett would say, well, no, I didn't. I didn't sell. I didn't lose anything. And when the real estate market goes down, if you don't sell your house, you didn't lose any money. The value of your house may have gone down, meaning if you sold your house, what would it be worth today? But if you're not selling your house today, what do you care? And consequently, when the stock market rises, when they say Jeff Bezos made $1 billion in a day, no, he didn't. He didn't sell any of his stock. I mean, the value of his stock went up. So presumably, if he tried to sell his stock, the value would be higher. But if you're not buying and you're not selling, then you're not winning, or you're not losing money or gaining money. Okay, it's just the facts of life there, folks. The only people who may have lost money yesterday without actively selling are people who are on what are called margin calls, people who have margin accounts of the brokerage firm where they're basically borrowing money from their stockbroker in order to buy stock. And if the stock market goes down too much, then the stockbroker goes back to the person with the margin account and forces them to pay up some more money to buy more stock to keep the margins up to shape. But that's relatively rare unless you're a professional investor. Most people do not have margin accounts. So is it the end of the world? No, it's not the end of the world. And it's not just me saying this. The New York Times is saying this. The New York Times, which has an interest in putting forward the notion that Donald Trump is leading to economic collapse. Neil Irwin over at the New York Times says, ignore the stock market. The underlying economy looks fine. He says, what is the stock market telling us with its precipitous drop over the last several days? In all likelihood, not much of anything. That's because the stock market, though crucial in the long run for individuals accumulating wealth and companies raising capital, is so erratic as to be useless in providing information about the short run. The 8.5% drop in the S&P 500 could signify the onset of a global recession. It could also mean that some trading algorithms at a big hedge fund collided in weird ways. Well, for what really matters, the well-being of the economy, look first to fundamental economic data. Second, look to bond market and other financial market indicators that are more reliable measures of investor expectations than stock prices. Basically, there's a theory going around over the last few days that the reason the stock market had a drop is because, number one, the wage data was goods, meaning the wage data went up, and so that meant that profit margins of companies were going down, so people sold some stock. That's possibility number one. Possibility number two is there were some signals from the Fed that the interest rates were going to rise, and that would make the lines of credit a little bit harder to get, and that means that the stock market is going to drop a little bit. Bond yields, I guess, were up, and so the stock market went down. Sometimes when bond yields go up, the stock market goes up. In any case, here's what Neil Irwin says, is there's good news on both fronts, as both point to a global economy that will continue growing steadily in the months and years ahead, perhaps with inflation that is a bit higher than in the recent past. This contrasts with market sell-offs with drops in 2011, 2015, and 2016, which coincided with pessimistic signals in both economic data and the bond market. The stock market can, when looked at in concert with these other indicators, provide some useful insight. Right now, it appears to be more noise than signal. And he says the economic data has been solid in recent weeks. On Friday, the Labor Department reported the U.S. added 200,000 jobs in January. The Federal Reserve Bank of Atlanta says they're looking at a 4% annual increase of economic expansion, which is a major number. That was the number that Trump promised, and people were skeptical he was going to get. course, there's plenty of statistical errors built into these numbers. They may turn out to be incorrect, but the bond market is looking optimistic about the future. Prices suggest that continued growth without inflationary overheating is the most likely future. The stock market has lost some ground since the start of the year because of the sell-off on Monday, but the yield on 10-year Treasury bonds is up in that span from 2.4% to 2.75%, which thinks that bond investors think steady recovery will allow the Federal Reserve to raise interest rates gradually. So in other words, this is just a market correction. Okay, now, it may take a few months for the stock market to go back up to what it was, but the idea that we are in a full-scale economic collapse is really stupid. There's no evidence to that effect. Now, maybe that's what it turns out to be, but we haven't seen that, and we haven't seen any underlying fundamentals that would suggest that at this point. This is why it's so dumb for commentators to blame or credit the stock market for a particular president. So Sean Hannity, he's a good guy, but this is so dumb. Yesterday, he blamed the plunge in the Dow on Barack Obama, who has not been president since last I checked, January of 2017. It is now, for those who missed it, February 2018. But I guess that if Obama can blame Bush, then Hannity can blame Obama. Here's Sean going after Barack Obama for the Dow plunging a year and a half after he left office.
Because the Obama economy was so weak all of these years, we had just artificially cheap money. Now, what's cheap money? Cheap money is when you can borrow at ridiculously low rates. The era of cheap money at some point has to come to an end.
Okay, so Sean isn't completely wrong about this, but it's not quite that simple. The fact is that they're not looking at tremendous inflation rates right now. I agree with his analysis of the stock market under Obama, but that wouldn't explain why the stock market has continued to rise under President Trump, even as the money supply tightens, because the Fed has been raising rates gradually. In any case, the stock market has very little to do with politics in the end. It has a lot more to do with confidence in particular companies. People don't buy, you buy indices if you're in a 401k, but most people don't buy indices. Most people buy certain stocks, right? They're picking a certain bundle of stocks, high-risk stocks, low-risk stocks. Here's the deal, folks. You want to make money in the stock market, take a little bit of money, invest in the stock market every month, and just leave it there. Just leave it there forever, right? Until you need it. Okay, if you did this and you've been doing this for your entire life, then when the stock market goes down, like this month, I'm excited. I do this every month. This month, I'm excited. I just got a discount on stocks. I get to buy a bunch of them. Right? Next month, presumably when the stock market goes up, I will buy again. And there's a good way to incrementally increase your portfolio, whether the stock market goes up or whether the stock market goes down. But everybody who's panicked when the stock market takes a dip like this, and we must need major government intervention, unless there is a serious underlying economic problem like there was in 2008, government intervention is usually unnecessary and even more so counterproductive.